Hello, one and all present here. This is Amit Kumar Singh. Welcome again to the class where we are discussing financial market. So far in the financial market, we have discussed about different components of it, be it equity market or a debt market or currency market or commodity market. So I've given you the glimpse of equity market so far in the class. It's still a long journey which we need to follow where we're going to talk about commodity, debt, and currency market. So already I believe now you all have got an idea that how stock market has actually started. What is the whole idea of working on a stock market? So primarily the reason of stock market, why it came into existence is to raise money from the market and then to sell that ownership, what is being raised in the illiquid form. So we have discussed these framework already. Okay, we have discussed about that in an ideal environment. Okay, the best way what you can earn return is not possibly by some guaranteed market plans which offer you 4 to 5% or 6% return, which is lesser than the inflation rate. So possibly you need to figure out something else which can give you better return than to beat the inflation rate. So we have discussed these framework. I have already spoken about Sensex. I've already discussed about as an investor in the market, as you are working on a market, you should have to act like a trader, not like a donor. Okay, so we have spoken about why does the stock market exist. The existence of stock market basically to raise money from the market whenever a company do a public issue and they want to raise money through equity. Ultimately, the ideal route what the company can do, they can target public. Possibly if you raise money from more than 50 people or worth more than 10 crore rupees from the market, automatically you have to do a public issue. And the first time when the company do the public issue, that is called as IPO, initial public offering. Okay, so please spend some time, need to know about what is primary market, what is secondary market. You have to get yourself aware about this part. So stock market is basically it's a legal and convenient way for an individual who want to become the part and parcel or the investor or the shareholder of the company. They can give money to the company, and that way the company give them the ownership. And this legal agreement works till the time the individual want to act like a shareholder. And then once the individual sell their shares in the market, ultimately if they get an appreciation in the value, that would be the return on the investment. So possibly that is the reason why an individual used to buy and sell stocks in the market, because everyone want return from the market. And because of the fluctuation of the market, when the market going up and down in very random manner, so if you can predict the price, maybe either following technical analysis, different oscillators and indicators of technical analysis, if we can follow that way, we can make money. So when you work for a trader, when you act like a trader, you can either do intraday trading or you can work on swing trading or positional trading. So we have discussed about this. We have discussed the different perceptions about the market. Now talking about the purpose of the stock market, already I have discussed that the basically the purpose of stock market for a company to raise capital, and this capital they raise in the form of equity. So this they're raising this capital in the form of equity. And when they do public issue, they primarily raise money from the market, where book running lead manager or merchant banker or underwriter basically assist them in whole process. Okay, and once the company raised money from the market, there are basically three kinds of investors who participate. They can be retail investor or HNI or QIBs. So these individuals participate in the market, and once the IPO of the company is being done, then the company lists themselves on the market. And that way when the company lists themselves on a market, then the buying and selling happens. And imagine if you buy some stock, maybe I'll show you one example. uh, like like see this example, that imagine if you have bought, this is basically of a company called Bajaj Finance. So imagine if you have bought an stock of Bajaj Finance. Okay, one share of Bajaj Finance in 10 year before was 149 rupees. Now it is somewhere trading around 7,584 rupees. So imagine the kind of return you would have got. So if you want to calculate the return, you are getting a return of 7,584.55 minus 149 divide by 149 into 100. You can calculate how much return you'd be getting here in this case. So this is one of the example. Imagine if you have taken done investment on this company called Bajaj Finance. So how much return you would have got by this time. So you have to understand that when we are looking for investment in the market, already I have mentioned that the best thing what we can do with ourselves is to get knowledge and invest our money. So when we are investing our money, we can invest our money in maybe in government instruments which guaranteed return they can give. Or what you can do, we can be more rational and invest in equity. So there's saying in the market that 100 minus your age, so 100 minus your age, that much money you should put in the equity. Okay, so because as the time progresses, your financial obligations will increase. So possibly then you can reduce your exposure in equity, but gradually sooner you start, it will be better for you. So if you invest in equity, you can get an ideal return from the market based upon the way the economy is behaving with yourself. Like last class, I think last two classes, I've given you example that the market cap to GDP ratio of a country right now is around 1.15. So market cap to GDP ratio is around 1.15. So you can understand that if you invest in the equity market of a country, you can get a return better than the GDP, because so that way you can understand that you are getting a return which is much more better than the productivity of the economy. So that way you have to understand that whenever we are investing our money, we are investing our money because we want to get a return which is more than the inflation rate. So the ideal formula here is 1 plus nominal rate of return. Nominal rate of return is the return what you get from any product, that is equal to 1 plus real rate of return into 1 plus inflation rate. Okay, this is the formula what we follow. And whenever you are working on investment, your ideal objective is to get a return which is better than the inflation rate. So the layman use the formula like nominal rate of return minus inflation, and they will say this is equal to real rate of return. Okay, that is a general perception how people perceive this. So always whenever we invest our money, the whole idea of investing your money is to get a positive real rate of return. So guys, you need to understand that, imagine if there's no stock market in the market. Imagine if there's no stock market, so where possibly you'll invest your money. So wherever you invest your money, which gives you maybe guaranteed return, maximum they can give you 7 to 8% FDs and all. If you do adjustment of inflation, hardly you'll get 1 or 2% return. That way, do you really think that you can achieve your financial obligations, you can achieve your financial dreams, whatever you are having? So you can, every individual, uh, you know that we have limited saving at the end of the month. So with that limited saving, we want to dream of getting a house. We have a dream of maybe buying a four-wheeler. So do you think that that really possible with the saving what you are having, or maybe with getting 7 to 8% return? Still, certain corpus of your investment you can park in government investments. You can put in maybe public provident fund or Kisan Vikas Patra or ELSS, equity linked saving scheme. So that way it help you in tax purpose. So under section 80C, that will help you under tax purpose. But beyond that, possibly after investment in insurance and all, you have to plan of certain form of investment in equity, may not be in active form, but in passive form also. In mutual fund, you need to think about investing your money. And altogether, whenever we are talking about this investment process, ultimately this investment process brings growth into the economy. So whole idea, whole motto of suggesting you to go for stock market is to make sure that as an individual, you and me, everyone should get an appreciation in our value, and altogether then in macroeconomics everyone will grow and our society will grow. So more or less when you see the investment, they are FIIs which are gaining investment in the market. So ultimately when we are looking for getting a value, we should always think of making an investment, so that ultimately as a retail investor we should also earn an appreciation on our investment. So getting 7 to 8% in FDs or Kisan Vikas Patra, those things looks good for tax purpose, or maybe for certain form of getting a guaranteed return. But beyond that, how much we can bring value to ourselves, and that way, if more and more individual will participate and invest in the market, the economy altogether will grow. So the rule of investment is that whenever we are working on investment, we have to make sure that we invest our money without losing our money. For that, getting a knowledge about the financial market is very important. And for that reason, only I'm developing these videos for all of you, so that you should get that financial knowledge of not losing the money. So this is the rule of investment. Don't lose your money and never forget the rule one. Okay, so question comes, then what about the people who are actually investing? 4 to 5% of Indians are actually participating in the market. So how they are participating? You know that around 95% of the investors who are participating, they're losing their money. So how then this whole process of investment happens? Do you really think that these people who are actually investing their money in the market, do you think that they have enough knowledge about the market, or they are always being lucky when they're investing in the market? So what is the logic? So they may be so what is the logic of their investment? So the logic of the investment, uh, possibly what I can guess, that maybe they're lucky, and wherever they are investing money, maybe they're getting a positive value on the investment. Maybe they are investing on the tips. Okay, there are a lot of channels are there a lot of Telegram groups are there, lots of WhatsApp groups are there where you pay some amount of money. They'll give you some stock market tips, and we're simply replicating those tips. Maybe somebody or someone in the market is actually making money. The third way of doing investment, or how they you one an individual can make money, maybe by doing intraday trading. So intraday trading basically means that you have to square off your position once the market get closed. So like you can actually trade between 9:15 to 3:30, and in that time period you buy and sell stocks in the market when you feel, when you are optimistic about any stock or market. Optimism is basically called as bullish. So if you are bullish on any stock on the market, if you feel that the stock price will increase, then you'll buy at the lower price, and then you sell once it reaches that higher price. So normally when we buy in stock, so we many times use something called stop loss and trigger price. So all that you should have a knowledge about stop loss and trigger price. I'll talk about stop loss and trigger price in our further sessions. So when we are optimistic in the market, we identify certain stocks which can possibly gives a value within the day. So when you're actually doing intraday trading, you are more relied on charts. You are more relied on the charts, price charts, by looking at it conjunction with volume. So if you are optimistic on the market, you buy and wait for it to rise to the reasonable level, and then you sell. Similarly, when you are trading in the market, if you're not optimistic, maybe you are pessimistic, or you believe today maybe market will fall down. That is represented by something called bearish. Okay, so what you can do, you can sell first and you can buy later. So you, because you know that the price will fall. So this concept in the market is called short selling. So this is possible only for the intraday trading. So what you can do, you can sell first your stocks in the market, because you know that maybe because of bearish nature, or maybe because of pessimism about the stock in the market, if you believe that the stock price will fall, so what you can do, you can sell that stock first, and gradually later on you can buy that stock. So that ideology of working on trade is called bearishness. Okay, so whenever we are working on intraday trading, either we are bullish or either we are bearish about the stock, and based upon that ideology, you perform your trade actions. Okay, so market opens at 9 o'clock. From 9 o'clock to 9:15, you have pre-market hour sessions where actual trade does not happen. That 15-minute time period is just to build up the demand and supply. Okay, and once the 9:15 get over, so then the actual trade starts. And from 9:15 to 3:30, we can participate in the market trading. We can buy some stocks, we can sell some stocks, so we can actually involve in the trading process. So the question comes that those people who are actually investing their money in the market, or those who are doing trading in the market, so do they really rely on intraday, or maybe because they're lucky, or maybe based on some tips, or maybe they identified some good company? Like I gave you an example of Bajaj Finance, that in 10 years the stock price from 140 it went to 7,000 rupees. So if you can identify those kind of stocks, so that way, if you are really lucky, you can even able to get around 40% return in the market. So Bajaj Finance has given actually 40% return in the market, and then your 1 lakh rupees can become 28 lakh rupees in 10 years. Don't get surprised to know this fact, because that is actual reality only. So there are different people who participate in the market. They have different intentions of working in the market. Some simply invest their money or simply trade based on some news or tips. Okay, maybe which are illogical practice. What they can do, that is pure gambling process. Some people, they identify good stocks. Okay, and then they may invest for a longer time period. Like I gave you this example of Bajaj Finance and all. So if you would have stayed invested in this stock from last 10 year, you would have got 40% return compounded per annum. That is the whole power of compounding. Like for that, I'll use this website called Screener. So here, if I search for the stock called Bajaj Finance, okay, so I have to complete it right. Bajaj Finance. So you see this stock, Bajaj Finance. So you can see this stock price of this. If I click on last 10-year chart of this company, so 10 year before, you can see the stock price was around 156, 10 January. It was around 156, and now today price is around 7,295. So you can see this, how much appreciation you would have got. You can easily calculate this. Imagine if I open Excel. So this was around 10 years before, it was around 157.38. So 157.38. And the current price of the stock is around 7,515, 7,515.05. Okay, so how much return you would have got? So if I use the formula rate, NPR is 10, PMT is 0, PMT means NUT, PV present value 157.38, future value is this. You can see you would have got 47% return in the market. So you can see this. So this stock has actually given 47% return in the market. So you can understand that getting 47% return, you can think that this is actual possible. So normally banks and all give you uh, 5 to 6% return on FDs and all. Maybe they're giving you 8% return. If you do the adjustment of inflation, how much possibly return you are getting, and see one stock has actually given 47% return. There are many stocks are there like this. I just given you one example. There may be some stock would have given better return than 47%. So I've just gave you one example. They would be much more bigger stocks and all. So don't get surprised by looking at those kind of stocks. So I just here also, if you see this market capitalization, company performance and all, you understand this is called P. P means price earning ratio. Price earning ratio basically means market price per share divided by earning per share. So imagine to get 1 rupee of earning, how much investors actually are paying for the stock. So they are paying 34 rupees to get 1 rupee earning of the company. So imagine tomorrow if the company will declare dividend and all. Imagine if they'll give 100% dividend, then they will give you 1 rupee, and for getting that 1 rupee, investors are actually ready to pay 34 rupees. This is the current price of the stock, 7,264. High, 52-week high. It went till 8,192, imagine. And the lowest was 5,486. Okay, dividend yield also, it has given a dividend of around 0.41%. Dividend yield, what do you mean of dividend yield? Dividend yield means how much dividend they've given divided by the market price. So 40.41% of the market price, that much they have given dividend yield. Okay, that much they have given dividend, not dividend yield. ROE means return on equity. Book value basically means, if you see the balance sheet of the company, if you subtract liabilities from the asset side, long-term liability, what you get is the book value. So sorry, I was just drinking water. So these ratios like return on capital employed, return on equity, you can spend some time. Capital employed is the total sum of total, what you say, liability of the company, which include equity plus long-term liability. ROE means it talks about the equity part. Face value means if the company tomorrow get bankrupt, how much they will give you per share. So the share which is trading right now 7,264. Imagine if you are having one share of this company, if it get bankrupt, they will give you 2 rupees. That means face value. Okay, so all this you have understood. So these terms also you should have an idea. Okay, these are the competitor of this company. This is the balance sheet. Sorry, this is the profit and loss statement. Okay, ratios of the company, balance sheet. So here, this So if you take the total liability, what return here means profit after tax, or EBIT 1 minus T. So that divided by the total liability will give you return on capital employed, where while if you take the profit after tax divide by the equity capital plus reserves also you can add there. So that will give you the book value or net worth of the company. Okay, these are the ratios and all, you can see this. So here you can see the growth of the company. So how much growth in the sales or profit or stock price you can see. So 10-year growth, it's showing 47%, which I just now shown you in Excel. Return on equity, you can see this. So imagine, I just give you one example, that imagine if you have done investment in this company, Bajaj Finance, maybe 1 lakh rupees investment if you would have done. Okay, so after 10 years, the value of that 1 lakh rupees would have become 28 lakh rupees. Don't get surprised. On this 1 lakh rupee, you got an interest of 40%. Okay. So we are assuming the return of 40% on this company. I'm not going for 47%. On an average basis, I just took 40%. So then this 1 lakh, if you get 40% interest, that become 1 lakh 40 after 1 year. On this 1 lakh 40, again, you got an interest of 40%, that became 56. Total interest become 40 plus 56, 96,000. And now total your amount of your investment from 1 lakh became 1 lakh 96. And that, if that will keep on happening, that is the effect of compounding. For the next 10 year, it has become 28 lakh and 92,000. Clear, everyone? This already I have explained you about Bajaj Finance, the kind of appreciation this stock has shown in last so many years. talking about market, market here basically means Sensex and Nifty. So to talk about Indian market, we represent Indian market with Sensex and Nifty. So and out of Sensex Nifty, we follow Nifty more than Sensex. So when I talk about Nifty, so if I'm talking about Nifty, Nifty is basically it is a portfolio of top 50 blue chip company. So when I'm talking about Nifty, Nifty is basically it is a portfolio of top 50. One, Nifty is basically it is a portfolio of top 50 large cap companies, top 50 large cap companies, while Sensex is the portfolio of top 30 large cap company. Okay, so if I'm talking about the base year of Sensex, that was 1979, and that time the total market capitalization of Sensex was considered as 100, and right now Sensex is trading around 70,000. Okay, so if I calculate the return of the Sensex, return on Sensex including dividend yield, I'll get somewhere around 18%. So if you calculate this return for 44 year, okay, you'll get a return of if you get a return of around 16%. Okay, so if you include dividend yield, okay, if you include dividend yield, definitely the 30 stocks on the of the Sensex on time period of the investment, they would have given some form of dividend to the investor. If that also if you being considered, then it altogether becomes somewhere around 18%. So imagine if you have done some form of investment even at 18% also. Imagine once if you have a daughter or son, your child, if you can accept all the receivable in the form of cash, okay, and the same money, maybe 50,000 also if you have done some investment, okay, imagine how much that would become once those uh, will go for maturity. Or imagine if once they get retired, your child get retired, how much value they'll get. So I'll just show you at the age of 60. So I really suggest all of you that that when birthdays comes, when our children birthday comes and all, we different form of our relatives, they come in and they gives us presents and all. I really suggest you can ask for you can ask for maybe you can ask for cash or something like that. So imagine if I just start with 50,000, I just start with 50,000, and imagine if you have done investment in ETF of Nifty or Sensex, so where you would have got 18% return. Okay, so 18% return you would have got. Okay, and so you can see how much the value they would get. Okay, so 50,000 into 1 plus this is the effect of compounding, 1 plus 18%. Okay, after 1 year, it became 59,000. So just if I log this cell J3, if I log J3 function F4 and H4 function F4, imagine, so it become 59,000, and this you can see. So imagine this much money if I simply put uh, imagine if this much money if I simply put in Nifty ETF or index fund or Nifty Bs, anything, because market, the best return what the market can gives is around 18%. How this 18% came, I hope you understood that I just use this formula. Rate is equal to time period was 44 year. Okay. Sensex in 1979, you understanding, right? Sensex in 1979 was around 100. Okay. And right now in 2023, Sensex is at 71,000 like that. So imagine if I take 70,000 only. Okay. So how much return you would have got? So that is what I calculated. So time period is what? 44 year, right? 2023 minus 1979. Okay. PMT is 0. Then PV is 100. Okay. FB is 70,000. So here you got 16% return. If I include dividend yield and all, you'll get around 18% return. So just imagine that uh, that tomorrow when I'll have my child, and then I request everyone that to give me all the presents in the form of cash. And if they give me in the cash and the same money, whatever I got, if I put in a bank, or the same money in bank can't give you 18%. So I want to go with the market behavior. So there are a lot of index funds are there, which primarily invest your money in Nifty 50 or Sensex 30, and how the market will behave, they will give you the similar form of return. So imagine worst case scenario also, if I'm getting 16% return also, not 18%. Imagine if I got 16% return also. So this 50,000 rupees one-time investment, if I do in some Nifty ETF and all, so once my child will get retired, imagine how much they are getting. So you can calculate this. So around 36 crore, 85 lakh, 10,068 rupees and 26 paisa, just 50,000 rupees of investment. If I just the moment my child got born, imagine 50,000 rupees. If I put in Nifty ETF. Okay, so that will give how much? That will give around 36 crore to my child once he or she look for retirement plan. So imagine this much, 50,000 rupees is not a big amount. We can anytime we can invest for our family or for our child, we can do that. So next time I really suggest all of you that you think in this manner. And so imagine how much return you can get. I'm not talking about do investment in gold or any other avenues. Okay, gold and all can give you better return also. So I'm just ignoring, I'm just talking on plain, I'm just trusting on the economy of my country. So 50,000 rupees of investment will give you 36 crore once your child get retired. So I believe that is the best form, that is the best thing what we can do for a child. So that there are many reasons are there why we can see such kind of growth in many firms. Like you've seen a company like Bajaj Finance, which is growing at around 47%. So what can be the reasons for the growth in some firm? Let me talk about, just hold it for a moment. So if I talk about the reason for the growth in some firm, basically at the end of the day, the profit what the company is making, some part of the profit, some part of the profit in the form of dividend they'll give to the shareholder. Okay, and the remaining part of the profit they retain with themselves, which is called as a retained earning. Okay, so this retained earning, year on year basis, the company put in the reserve and surplus, and that will give something called internal equity to the company. So when we talk about something called retention ratio is retained earning by profit after tax. Okay, and so this retained earning, the part of the earning which the company is actually retained, they have not given to their shareholder. Okay, that on year basis in the form of reserve and surplus act like an internal equity for the company. And tomorrow if the company need fund for any reason, they can use this reserve and surplus. Okay, keeping too much reserve and surplus is not good because of inflation. So this retention ratio, if you multiply with the return on equity of the company, you will get the growth rate of the company. This is the fundamental analysis technique to analyze or to work on the growth of the firm. So every firm in their lifetime, they follow different growth model, a lag phase or log phase. So imagine if the company is having a sustainable business model, which have bigger value in the long run, definitely that company will show a better growth prospects. And when and based upon the growth prospect of the stock, the share price of the company will also keep moving. So as an investor, whenever we do investment, we should look for the should look for the kind of risk what the can have. When you do for investment, it can have these forms of risk. Okay, we'll talk about these forms of risk in future. So more or less, there are different forms of risk, and a stock can have, a stock can face the risk. Can be systematic risk, it can be unsystematic risk, market risk, liquidity risk, obsolescence risk. There are different forms of risk are there, but it what matters is that we should identify good business. And once we have identified the good business which have long term prospects, we should invest our money for a longer time period. Okay, so there are stocks which have given much more better return than the market. I've given you one example of Bajaj Finance. Here, if you go to this website, you can see, if you are looking for stocks which give dividend and all. If you're someone who rely more on dividend, I will really not suggest you that be too much optimistic on dividend. But imagine if you are someone who look for dividend as some form of constant income. If you are doing investment, then there many companies are there in India, which on periodic basis used to offer good form of dividend to this investor. So if you are someone like this, you can definitely go for them, but I really don't suggest you that you should look more dividend, because ultimately that will reduce the reserve and surplus of the company, and that way it will reduce the growth rate of the company. I hope you got an idea about this. So understanding the market and then behave rationally is the fundamental concept of fundamental analysis. If you are working on fundamental analysis, it is very important that you should always look for long term investment. So as per the Warren Buffett, we don't have to be smarter than the rest, we have to be more disciplined than the rest. That is the ideology of Warren Buffett. And with that ideology only, I want to end this present class. I'll discuss more in our next class. I hope you guys are liking our discussion so far. If you have any doubt, you can come back to me and ask as many doubts as possible. So far in this class, we have spoken about the whole idea of doing investment in the market and why we should do invest in the market, and what is the fundamental concept or the ideology what we need to keep in mind when we do for investment. So I hope you have understood what all I have discussed so far in this class. It's time to say goodbye to all of you. Thank you, everyone. I'll see you very soon for the next class. Take care. Bye, everyone.